Hey everyone, welcome to Paisa Pathshala. If you've ever looked at a mutual fund brochure or a stock market app, you've definitely seen that tiny disclaimer, past performance is not indicative of future results. It sounds like boring legal jargon, but ignoring it can cost you thousands. Let's break down why this one sentence is the most important rule of investing. Think of it like a cricket match. Just because a batsman scored a century in the last 3 games doesn't guarantee they'll score another century tomorrow. The pitch changes, the bowlers change, and their form might dip. Investing is exactly the same. Market conditions are always shifting, and what worked in 2021 might not work in 2024. When we see a fund that gave 30% returns last year, our instinct is to think, oh, this is a winning fund, let me put all my money here. But in finance, this is called chasing returns. Often, by the time you notice a fund has done really well, the prime time to buy has already passed. Market cycles are real. Imagine a sector like IT or pharma. 1 year, IT companies are booming because of global demand. The next year, they might struggle due to high inflation or lower spending. If you invested in IT just because it was the best last year, you might end up buying at the peak right before a correction. Let's talk about mean reversion. This is a fancy term for a simple concept. What goes up usually comes down, and what is down often recovers. An asset that has outperformed for a long time might be overvalued, meaning it's priced too high. Buying it then is like paying full price for a shirt that's about to go on sale. Another reason this disclaimer exists is survivor bias. We only ever hear about the funds that are currently performing well because they are advertised. The thousands of funds that performed poorly or shut down entirely, they are hidden from the leaderboard. You aren't seeing the whole picture, you are only seeing the lucky winners. So, if past returns don't matter, how do you pick an investment? Instead of looking at a chart of the last 1 year, look at the fund's investment philosophy. Does the manager have a strategy they stick to? Are the costs, known as the expense ratio, low? These are things you can actually control. Think about your own goals. If you are investing for a goal 10 years away, like buying a house, a short-term dip in a fund's performance shouldn't scare you. Your focus should be on asset allocation, mixing things like equity, gold, and debt rather than trying to find the one magical fund that will always go up. A great example is the Nifty 50. It's a basket of India's top 50 companies. Over 20 years, it has trended upwards, but if you look at any single year, it has seen massive ups and downs. If someone had sold during the bad years, they would have missed the long-term growth. Consistency beats timing every single time. So, here is your takeaway. Don't buy a fund just because it topped the charts last year. Instead, pick a fund based on its long-term strategy, its cost, and how it fits into your overall portfolio. Invest through and sip, stay patient, and let time do the heavy lifting for you. See you in the next one.